how the wealthiest people in America write down their tax bill. They use this strategy called the short-term rental loophole. That's our topic for today. Guys, my name is Andrew D'Amico. I'm a CPA partner here at Ledgerly, alongside my partner Mike Abrahamian, also a CPA, where we're focused on providing our clients with tax saving strategies, asset protection strategies, as well as helping them build the foundation for generational long-term wealth building. If any of those three things speak volumes to you, please make sure you're subscribing to this channel so you can stay up to date on all the videos that we're pushing out around those topics every day for our clients. Now I want to dive right into it, but before we do that, we need to understand real estate as a whole before we get specifically into short-term, the loophole and this strategy. And this strategy is going to be for that high-income W-2 person or even a small business owner, but they're crushing it in business. They have a lot of income that they're reporting on their tax return. How do we reduce that so we don't have to pay so much in tax? So that's who this video is for. So macro level, let's zoom out. And first, we need to understand how we're getting taxed on our ordinary income, that day job or our business if we're self-employed. And then over on the other side, our passive investments or other passive activities, what assets we have, and how it flows down to us personally. So as you can see, I've drawn up a trifecta here. If you're not familiar, check out our other videos. But essentially what it is, it puts your income, your life in a picture on a diagram that you can understand your income, your assets, and how it flows down to you personally. Maybe on the left side here, you have a W-2, maybe it's a high paying job, an LLC for any small business that we might have, or maybe your spouse has. And then on the right side, for that long-term wealth, maybe we have some retirement accounts, 401k, IRA in the picture, maybe any HSAs. And then the focus of today's topic is over here. You can see my very poor draw picture of a house. It's going to be held in an LLC, and this is going to be our rental activity. Now, when we're on the left side of the frame, we're going to be paying Medicare and Social Security taxes. That's our FICA. Now, in a W-2, you're only paying half of that because the employer covers the other half. But then specifically here in this LLC, if we're self-employed, paying self-employment tax, which is both sides of that equation. And that's about 15.3%. That is tax on any ordinary income on the left side of the picture. Now, on the right side, now granted, retirement accounts, those grow depending on the type, and they either come out taxed or tax-free, but there's not going to be any FICA taxes on that. And similarly, with the LLC on a rental property, the IRS deems rental activity passive in nature, and passive income is not subject to self-employment tax. So that's the benefit on the right side of the equation. But if we're generating passive losses through a rental activity by deducting things like depreciation, we're going to be generating a loss. However, when it's passive, we cannot use passive activity to offset ordinary income. And this strategy is a workaround to that fact. Passive losses can only be offset against passive income. If there is no income to offset it with, that passive loss gets disallowed. It gets captured on your tax return and it gets carried forward until you have passive income to recognize it against, or you dispose of that passive activity. So you will ultimately see that benefit, but if it's disallowed, if it's long-term generally, it's not going to be deductible in the year the loss is incurred. And today, everybody wants their cake and eat it too. Everybody's thinking about strategies today. I want to reduce taxes today. That's what the strategy is going to do. So the goal of this strategy is to unlock losses that we're incurring here. So how can we push it over from the right side of this board to the left side to reduce our high income over here and ultimately pay less taxes down here on the 1040? So that's where we're headed. Let's get a clean sheet here, because now that we're talking about real estate specifically, we need to understand the difference between short-term real estate and long-term real estate. So just definitionally speaking by the IRS, they're going to consider short-term real estate where the average rent is 7 days or less, and long-term on the flip side is greater. The average stay is greater than 7 days. So we're going to put ST for short-term over here, long-term over here, and then the barometer is, I got some colors here, so might as well use them. This is going to be less than 7 days. And this is going to be greater than 7 days. And now that's specifically talking about how many days is it rented out, not available for rent, but how many days is it actually rented out. Let's say you buy a rental property and you place in service, start renting it out immediately near the end of the year, November 1st. Gives you about 60 days for the rest of the year. Let's say you rent it out every single day and you have 10 tenants. On average, that stay is going to be 6 days. So we'd be over here in the short-term bucket. But let's say you only had 6 tenants. That average is 10 days. So we'd fall over here. And there are a few caveats with this rule, right? If we have any personal use of the property, whether it's you yourself or you let your parents go or your friends go and they're not paying you, that's considered personal use, and you would have to take that out of this equation, and they couldn't be considered tenants, right? Tenants is when we're giving it to a third party and they're paying us for the use of said property. So what is the taxation? What is the loss treatment between these two? So if we're in the long term, there's actually a special allowance where you can deduct up to $25,000 of any losses in a given year. However, if you're going to take that loss, you have to be under a certain dollar amount on your modified adjusted gross income. That number is $100,000. And if you creep over that amount, then this $25,000 gets reduced and it's completely phased out at $150,000. So we'll say, right, we have the phase out rule. So if we get over 150, we can't take any of this loss into what I said before. It would get captured on your tax return and it would be carried forward. So there's a benefit, but like I said, the strategy is really for that high income earner where we're going to be above this and we can't take that loss in year one. So that's what we're looking at the long-term side. Now on the short-term side, just because it's short-term doesn't automatically make it ordinary and get us outside of this requirement. So this could play out in a few different ways, but it could be active or it could be passive, right? Passive being it's going to be just like this. Or if it's active, it's going to be, we're going to be able to take losses against that ordinary income, right? From the first trifecta against our W-2, any self-employed business we own, and no limit on the losses. There's no 25K cap. But again, in order to get to this bucket, we have to pass a few tests. And if we're not careful with the way we're running this rental property, we might subject ourselves to that 15.3% tax that I was talking about. So we don't want to incur that. So like it says, it's a short-term rental loophole. So we have to be very careful with this. But just wanted to call out high level. That's where we want to get to. But even still, I want to bring home and help you guys understand that this is for real estate losses. Now, you might be thinking, I hear people all the time talking about how great their rental property is and how high their cash flow. Well, enter in depreciation. Let's understand depreciation. So for those not familiar, depreciation is when you have an asset that is expected to provide a benefit greater than 1 year. The IRS says you can't immediately expense that. Let's say you buy a piece of equipment for your business that you're running. Take for me an example. I run an accounting firm. Let's say I buy some really jacked up, souped up laptop for like $5,000. The IRS says, hey buddy, that laptop is still going to be good for you in year 2, in year 3, year 4, year 5, right? So they tell me, and the rule is you have to capitalize that, i.e. you can't take a $5,000 deduction in year 1 because there's future economic benefit. So the IRS gives guidance and says like, okay, you can write off a piece of that in year 1 and a piece in year 2 and on until the useful life is up. So the IRS provides depreciation tables. And you can fall into a bunch of different buckets, right? There's 3-year property, there's 5-year property, 7, it goes on and on. And specifically talking about real estate, right? A property, a home, it's obviously going to provide benefit past year 1. You don't buy a house with the expectation that it's going to collapse in 365 days. So the IRS actually says residential real property, we're going to have a rental property, people are going to be renting it out, it's residential in nature, that's 27 and a half years. And then it jacks up to 39 for commercial. There's another bucket for 40. But you get the gist. There's a bunch of different class lines. So why is this important? On the face, right? You buy a home, it's going to default to this 27 and a half. And just take the straight line method, divide it by 27 and a half years. If you're cash flowing more than that, then you're not going to have a loss. So how does this help us? Well, if you're familiar with bonus depreciation, you might have heard of with Trump's tax bill, all the fuss about, oh my God, 100% bonus depreciation is back. What does that mean? Well, bonus depreciation allows you to do exactly what the IRS says on the face that you can't, right? We want to write off 100% of a new asset we purchase. We want to write it off all in year 1. But this rule is limited to asset classes that are 20 years and under. So that's what we could take this on. Now, how does that help us in our example if we're outside that range? Well, we implement what's called a cost segregation study, where you go to a firm, a company that provides a service, they do a study of your home where they essentially value all the different assets, right? Because the home, the structure, we're hoping it's going to last more on this end, right? It's going to last 27 and a half years. But maybe the doors, the windows, cabinets, refrigerator, other appliances, those don't all last for 27 and a half years. So with this valuation, what the cost seg study does is it breaks out the value of all those different asset classes and applies a value to it. So quick example, I said $275,000. Let's say, as a whole, it's 275K. Let's say the land is 25. And when we get the cost seg study done, they come back and say, hey, all your I'm just going to say 3 to 15 year property is worth $100,000. And then the rest of the home is, whatever that math is, $150,000. So this, with the reinstatement of 100% bonus depreciation, we could potentially get a $100,000 deduction in year one. And that's how we generate a loss. And that's how we supercharge the short-term rental. We generate that quote unquote paper loss, and then we pull it from the right side of our trifecta over onto the left side, reduce that W-2 income. That's the road we're going down. Now, specifically, how do we make sure we're getting our rental activity in the right bucket? How do we qualify as a short-term rental where we're not going to get hit with self-employment tax and we're going to unlock losses in year one? So really it comes down to two tests: substantial services and material participation. So they say you can't be providing substantial services and you need to be materially participating in the activity in itself, meaning you're involved with it. But let's start substantial services. Think of it like a hotel, because a hotel on its face, yeah, you're renting it out. It's rental activity. It might seem passive, but hotels are actually operational businesses, right? Because the average stays of those, people aren't renting a hotel typically, not for 30 days. They're going for a long weekend. Maybe they go for a week. Generally, they're going to fall under 7 days. So it's operational in nature. And then on top of that, what are they doing? They might have a continental breakfast. They have a concierge desk. Maybe they have a travel or help desk that gives out pamphlets or tour guides, activities to do in the area, right? They could even have a restaurant in the hotel. They're providing much more than just a room to stay in. So it's more active in nature. So a hotel will get hit with self-employment tax because it's running it like a business. So in order to qualify for this strategy, we can't be doing daily cleaning, right? Changing the sheets, giving them more towels. Can't be providing them like a bed and breakfast or whatever. So we'll say breakfast. I said that piece on the entertainment. You can't be being a tour guide or showing them around, but we'll just loop it in as entertainment, right? So those are a few quick examples of substantial services. In order to qualify for this, we do not want to be providing substantial services. And then on to our second test, we need to be participating in it materially, so we consider to be active in it. Now there's 7 different tests. You do not have to hit all of them. You just have to hit one. But there's a lot of language in some of them, so I'll just whittle it down. I mean, you could look it up, but like the top 3 that are probably easiest to hit are: you participate in this rental activity for more than 500 hours for the year, or you substantially provide all the services. I'll say you over everyone else, or you do 100 hours and you're the one doing the majority of the activity. Running out of space here. Close enough. Now you might be thinking, you just said you can't be providing substantial services, so how am I going to hit my hours? Well, no, these activities are different. So what can qualify for these hours? These are things like managing the booking online. So I'll just say managing, right? You're on an Airbnb platform where the property is listed, or VRBO. So you put up the listing, you set the price, you're communicating with tenants, you're vetting them, doing your own research on them, you're calling them, talking to them, you see their application, you approve, they go and stay, they call you with problems, you coordinate whatever they need done. And that's another one too, like coordinating, we'll say repairs and maintenance. And I'll put a star next to that because you might think, oh, okay, something's wrong with the plumbing. I'm gonna go to Home Depot. I'm gonna search up some YouTube videos, educate myself, and just do the repairs myself, save some money. If that job, that repair takes you, let's say 10 hours to do, but it would have taken a professional only 2 hours, in the event of any audit, the IRS would come back and say like, hey buddy, that's a 2-hour job, you took 10. You can't take credit for the 10, they'll only give you credit for 2. So when in doubt, outsource to, a professional, a tradesman, right, an actual plumber. But the coordination of that, or going and making sure that the plumber has everything they need to do this repair, right, those sort of activities, those can count towards your hours. But I would advise against trying the DIY model, doing it yourself. Also, similarly, finances, right? This is going to end up in our tax return somehow. So do you have a QuickBooks? Are you the one maintaining the books for this property, booking the transactions, putting together financials, and reviewing them? Those can count towards your hours too. But again, it's that same caveat. If it would take a CPA only 2 hours to do, and it took you 20, you only get credit for the 2. So a little caveat there. But those are some ways that you can get these hours and meet these tests to be materially participating. And just to bring it home right here, right? We want to be materially participating, and we do not want to be providing substantial services. So if I could sum up the test very briefly, this is what it would be. So now that we understand everything that goes into the strategy a bit better, what could the ultimate benefit be to you in a year that we do this? So let's bring it home with an example, shall we? If you forgive me as I erase everything. Hopefully don't knock down the whiteboard. I probably should get a better stand, but that's a me problem. All right. So let's say we have a taxpayer, husband and a spouse. Let's say their modified adjusted gross income is $300,000, right? Because I said with the long-term rental, if it's in that category, you get the $25,000 allowance a year, but it's capped over $150,000. So these guys are not going to see any benefit in the current year from a long-term rental. So that's important. Now let's say our property, they get it for a list price of $450,000. The land on that is $50,000. So that leaves us with a net of the actual structure itself is $400K. And remember, this is going to default to 27.5 years. So we can't bonus depreciate anything because it's all in that asset class. So enter in the cost seg study. So we'll say cost seg, let's say 3 to 15 year property. That comes out to $100,000. So now our new with the cost seg is $300,000 that's falling in the 27.5 year bucket. But this $100,000, this is going to be what's eligible for bonus depreciation, where we're going to get that extra write-off. And now let's bring it home with some easy math. Let's say our rental property is producing cash flow of $10,000, right? We're in the green. And now with this new deduction, right, we're going to apply 100% bonus depreciation. So we're going to get a deduction in year one of $100,000. So we have a $90,000 loss that we want to take. Now, if this was long-term, right, our friend's net income is still going to be $300,000. We can't use that in year one. If it's short-term, what does it become now? Now it's $210,000. Because, right, I'm taking this 300, I'm lessening this 90, and now I get to this 210. So what do the tax savings look like on that? Let's assume they're in federal bracket of 24%, and their state, call it 6% maybe. So effectively, they're going to get taxed on 30%. They're going to get a 30% tax on this income. So let's apply our rate. And if I could do math in my head, please keep me honest here, but this should come out to $90,000 in tax. You know what? Let's color code this. If we're in the long-term bucket, this is going to be $90,000 tax. But for my short-term friends who are doing the loophole, we are only going to pay $63,000 in tax. Right? So I just got $27,000 in savings. Terrible circle. But you could see how powerful this could be for a high net worth individual and why the wealthiest people in America utilize this strategy. So they can get significant tax savings in the year they do it. And now there are obviously a lot of ways to optimize this. There's some caveats you got to look out for, right? Like I mentioned, the personal use. Also, if you have the entire rental for the whole year, it might be hard to hit those hours. Like I said, you have to be the one providing most of the service in some of those material participation tests. So are you doing more than your cleaning services people? Are you doing more than the plumber, the electrician, on and on? So for that, it would be important to keep time logs to make sure you're documenting and you could actually prove you provided the hours that you claim you did whenever the IRS does ask, because they will ask. This is a heavily audited area. When they were coming out with the regulations on rental activity, they did not see Airbnb, VRBO on the horizon. The regs are kind of outdated. So this short-term rental loophole, it's here right now. You can take advantage of this strategy now, but there's no telling if it's going to be here in 5 years or 10 years. But the State of the Union, you keep your records and they ever do ask, it should be a cakewalk. Just because it's heavily audited doesn't mean that this is a strategy you shouldn't consider. So guys, I hope you found this helpful. Please subscribe to this channel if you want to continue to learn more about tax saving strategies, asset protection strategies, and generational wealth building strategies. Thanks for tuning in.